Hi everyone! Last week was not eventful, but the stock indices managed to score gains. They reached new highs, boosting sentiment on Wall Street. Since Thursday, market strategists have been providing various forecasts on the Fed's rate decision and the likelihood of a bull market. They had plenty of time to analyze trends and sentiment in the stock market as there were no crucial economic reports. Analysts stress that not only large-cap companies and tech giants are now showing growth. Investors began to pay more attention to cyclical sectors such as energy or manufacturing ones, as well as stocks of small companies. The Russell 2000 index climbed this month. A meteoric rise last week gave hope for a bright future for stocks. Equities may start a recovery after a prolonged downtrend. The bullish sentiment will be tested by the Fed meeting. However, before this event, the inflation report is on tap. The ECB and the Bank of Japan will also hold their meetings. Watch our video review and find out more interesting news. Let's start. Even despite a strong bullish bias, cautious trading prevailed last week. The buoy volatility index, known as Wall Street's FEGOG, ended below 20 for the first time in nearly a year on Friday. According to technical analysis, a steady rise of the S&P and close of the trading sessions up more than 20% from its October 2022 lows could mark the start of a bull market. However, past performance is no guarantee of future results. Markets may be volatile. Apart from that, corrections could begin. Many investors prefer sitting on the sidelines ahead of the Fed meeting, as they expect the end of the tightening cycle this year and a possible interest rate cut in 2024. The Fed is likely to keep the key rate in the range of 5.25% by the end of the two-day meeting on Wednesday. However, markets are pricing in a 70% chance of a rate hike at the July meeting based on CME Fed Funds futures. Speculators also believe that the regulator could cut the interest rate by 100 basis points next year. The leading Wall Street banks expressed a similar point of view. They assume that the central bank is highly likely to raise the key rate by another 25 basis points in July. In addition, the unexpected rate hikes by the Reserve Bank of Australia and the Bank of Canada last week signaled that the global tightening cycle is not over yet. Traders seem to have taken into account the comments of Fed governors Christopher Waller and Philip Jefferson. They said that it was possible to skip a rate hike at the upcoming meeting. However, it does mean the end of monetary tightening. Skipping a rate hike at a coming meeting would allow the Fed to see more data before making decisions about the extent of additional policy firming, Jefferson said. The optimism on Wall Street was also bolstered by initial jobless claims data. The U.S. labor market is cooling due to a significant drop in household employment and an increase in the unemployment rate in May. The ISM manufacturing index has been falling for 7 months in a row, while the ISM services index barely grew in May as the number of new orders slowed. At the same time, employment in the United States remains high. In May, the economy added 339,000 jobs, which was above the pre-pandemic levels. Since January 2022, the unemployment rate has not exceeded 4%. It remains to be seen whether the labor market will be able to expand amid monetary tightening. However, traders are more focused on the inflation data. The report will be published on Tuesday. Consumer prices are likely to fall slightly in May compared to the previous month. Core inflation is forecast to remain unchanged. The Dow showed a mixed dynamic last week. On Friday, it was able to grow by 43 points, or 0.13% to 33,876. During the week, the Dow added 0.33%. As the US economy keeps expanding despite interest rate hikes, fears of an imminent recession are easing. Some investors have shifted attention to cyclical shares. They were less attractive this year. These are stocks of small energy and industrial companies. In June, all of them showed significant growth. The stock market is gaining momentum despite gloomy forecasts. It appears bulls may take the upper hand in the near term. There are still a lot of risks for investors. They are waiting for inflation data and a day later their producer price index to assess the results of aggressive tightening. Optimism on Wall Street was also facilitated by expectations of a pause in tightening, high incomes of households, and the artificial intelligence boom. At the same time, the upside potential of the Dow was limited by falling oil prices and the downbeat results of Apple. Its shares decreased after the release of its highly anticipated Vision Pro virtual reality headset. The Vision Pro will start at $3,499, more than 3 times the cost of the priciest headset in Meta's line of mixed and virtual reality devices. The S&P rose by 4.93 points or 0.11% to 4,298 points, extending its 4-week winning streak. This is the longest one since July-August 2022. Last week, the S&P increased by 0.38%. On Thursday, the index gained 20% compared to the lows of October, signaling a bull market. A 20% increase from bear market lows heralded further upside for stocks in the past. In 4 of the last 6 bear markets, the index went on to rise 20% or more in the 6 months after hitting this milestone. This turning point could come as the Fed is expected to keep the key rate unchanged on Wednesday, which will be extremely bullish for stocks. Besides, the rally of the index was due to the growth of only a few companies. The performance of just 7 stocks, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Platforms, and Tesla, accounted for all of the S&P's total return this year, according to S&P Dow Jones indices. At the same time, pressure is still increasing as the strong US dollar and high interest rates continue to affect the profits of companies. In addition, lower liquidity in the market is likely to lead to a sharp drop in corporate earnings. High interest rates have had a negative impact on corporate profits in 2022, causing the S&P to fall by 20%. Central banks have raised rates by more than 1,700% to curb inflation. They warned that rates could remain high until the end of 2023 as inflationary pressure persists. Morgan Stanley anticipates that corporate profits will post a 16% decline this year before seeing a sharp 23% rebound in 2024. The NASDAQ ended Friday trading 20 points higher or 0.16%. The index climbed to 13,259 points or 0.13% last week. Shares of tech companies are likely to start a long-term rally and may advance by 10–12% in the second half of this year. Tech stocks have already shown a good start this year thanks to the hype around artificial intelligence. NASDAQ jumped by 27% in annual terms amid the rapid growth of companies working on artificial intelligence such as Nvidia. The overall investment in artificial intelligence development totals approximately $800 billion. However, the monetization of artificial intelligence is happening much earlier than expected thanks to Nvidia. Microsoft and chipmaker Nvidia are dominating the artificial intelligence scene but other companies such as Google, Oracle, Amazon, Salesforce, Palantir, IBM, Meta, and C3I are also working on artificial intelligence projects. It looks like a race for leadership in this industry. Tech giants in the software chip digital media ecosystem should create platforms around ChatGPT, other artificial intelligence models that will change many industries for years to come. Large investors are also optimistic about the artificial intelligence industry. Billionaire Stanley Druckenmiller pumped a combined $430 million into NVIDIA and Microsoft stocks in big, bold artificial intelligence bets in the first quarter. He expects to own NVIDIA stocks for 2 or 3 more years. Artificial intelligence could be as innovative as the internet, he stressed. The index is also gaining steam amid expectations of a pause in the Fed's aggressive policy and rate cuts in the near future. As for individual stocks, Tesla logged the best weekly performance. The company's shares rose on Friday for 11th trading session in a row, setting a new record for its longest winning streak ever. The prior record was 11 consecutive gains, which was first reached in January 2021 and was matched on Friday. The rally followed recent deals with General Motors and Ford to expand Tesla's charger network. In May, Ford announced it would allow its electric vehicle customers to use Tesla's charging stations in 2024. Last week, General Motors announced a similar deal. Given the recent announcements by Tesla, General Motors and Ford, analysts clearly see the ongoing evolution of the electric vehicle charging industry as technology evolves, with industry stakeholders coming together and evaluating best practices. This news boosted bullish sentiment as Tesla's charging infrastructure has succeeded in being the standard across electric vehicles. On Friday, Wedbush raised its 12-month price target for Tesla stock to $300 from $215. The General Motors and Ford deals could bring in an additional $3 billion of revenue next year. That is all for now. Subscribe to our channel and stay up to date with the latest market news. See you.